All right, perfect. Well, thank you so much for the opportunity, Joe. I appreciate it. And what you were saying is just so true. My journey, which I'll share a couple of things off in the beginning, that really created some massive aha moments for myself. It took a couple of years, but there was a couple of central things that I saw some of the very wealthiest folks and investors that I was around do. And when I started to get obsessed about money, how money works, how the rich really invested their money, I was just amazed at the two different worlds that were existing. I always say, what some of the ultra wealthy individuals are doing isn't necessarily different from the average person. It's the complete opposite. So it kind of blew my mind, went down a rabbit hole, read as much as I can, and I'm going to be sharing a lot of the things that I've learned on my journey with you guys. So let's get started. So what Joe was talking about was how to create your banking system and how to become the bank. So in this presentation, my goal is to show you that you can essentially set up a banking system in 30 days or less. So just a little bit about myself. As Joe mentioned, my name is MC Laubscher. A lot of folks know of me by my show, The Cashflow Ninja, which is one of the podcasts that I've done. The show's been downloaded over 3 million times in over 180 countries. We've essentially turned that podcast into a full-blown educational online company. And there's a lot of exciting things that we're rolling out. And this is actually a phenomenal time to work on a lot of those projects that were basically shelved. And now we had the opportunity to do that. So super exciting to keep sharing more and more of what we learned, because there's just so many amazing strategies that we've learned over the course of 20 years. And I'm also the president of Producers Wealth. Producers Wealth is a virtual firm that serves clients in all 50 states. We specialize in cash flow strategies, and we help business owners and investors create, recover, warehouse, and multiply their cash flow. And I'm going to share a couple of that strategies of exactly how we do that with you today. Just want to touch on my show quick. So I've been very blessed and honored to learn over 20 years. I've had great mentors for over 20 years, learning from folks that are doing quite extraordinary things. And one of the things that my show has allowed me to do was get access also to some of the greatest minds in finance, investing, business, real estate. I've had Robert Kiyosaki on this show several times, Grant Cardone. I actually had interviewed Jim Rogers last night, 10 p.m. It was 10 a.m. in Singapore, but I just interviewed him again. Presidential candidate Dr. Ron Paul, Kevin Harrington from the Shark Tank, and Russell Brunson. So it's been amazing. Because of the podcast, the growth of the podcast, we get access to these individuals and get to spend basically an hour with them, asking them, what do you do? What are some of the strategies that you're doing? Who's part of your team? Because you're not doing what everyone else is doing. So it's been amazing to learn from these individuals. Just want to share, those are the two shows that I'm doing. The one is Cashflow Ninja, one is Cashflow Investing Secrets. I want to start with this quick, because a lot of folks know this book, Rich Dad, Poor Dad. And this was a big aha moment for me. One of the biggest lessons, obviously, from that is cash flow, right? A lot of people started talking about cash flow, the difference between assets and liabilities. Principles such as the rich don't work for money, right? They have money working for them. So a lot of folks have probably seen or are familiar with the book, and also what Robert Kiyosaki shared in the book about the income statement and the balance sheet, the financial statements of a person, right? And that's very well known. I've read that book a couple of times. I try to read it every year, because every single year there's something else that I pick up within that book. And one of the first moments that as I mentioned, was cash flow. That's very important. Invest for cash flow. Generate passive income or have multiple streams of income. That's very important. But as I read it, I realized that this was, as he said, a book on accounting. It's a book on financial statements, yes, but there's a lesson deep inside this book which started to click with me. What he was really showing us was the power of being the bank and how banks operate, because we can look at our own financial statements and see what are our liabilities and what are assets, right? We can see that, but there's another side of that coin. So there's another world, right? There's your world and the other world. So what are assets on, or liabilities rather, on your book is assets on someone else's book. So I looked at this and I said, mortgages, HELOCs, auto loans, student loans, credit cards, personal loans, business credit lines, business loans, they're all assets of the bank. That's their assets, right? They're liabilities for me, but it's the bank's assets. So then I took a step back and I said, you know, I've looked at this, and this is quite amazing. I've seen banks. They have pretty big buildings everywhere. They also own the nicest pieces of real estate. I got to take a closer look at this. And what have they figured out? They have a constant flow of deposits. They have a low cost of capital. They warehouse their capital very efficiently, which will become very much more important in our discussion today. They collateralize capital, which is just a super ninja trick. And I'll talk about that too, about what collateralization means. They leverage capital. We're all familiar with that, with folks being in real estate. They create assets that pay them income, and they create symbiotic revenue streams and have multiple profit centers. You know, there isn't just one product that a bank's going to try and sell you. You just open up your checking account and they're already pitching a credit card, right? So they know the game and they figured that out. So I really, really dove into studying what's banks, how they work. You know, another book that changed my life was Becoming Your Own Banker by Mr. Nelson Nash, which became a mentor for almost a decade of my life. But one of the things that really drove it home for me is said, okay, that's fine. I see all the benefits of being the bank. Let's look at some numbers, right? Let's look at their overall strategy. And what was amazing, if you look at the banking system, and again, this is the traditional banking system, very simplified. We're not talking fractional reserve lending. we're not talking about just receiving money for nothing and bailouts. We're just talking the traditional way that banks work, right? And still smaller banks still operate in a very similar way. So essentially, there's two sides in a banking system. There's a deposit side, a stream of deposits coming in, right? So we put our money in the bank. They used to pay us something for it, but we still do it because there's online bill pay. There's still benefits to putting money into a bank, right? Then there's, on the other side, there's a lending side of the bank. So they receive deposits and then they actually make loans with the money that they received. So, and that's really where the magic comes in. So the example that I use here is if I put $10,000 in the bank, and let's just say the bank pays me 1% on that, right? Which is still a lot more than what they are right now. And then they take that same $10,000 and they turn it around and they make a loan at 10% to someone. Maybe it's a business loan or so forth. What does that look like? And most people would say that's a pretty healthy spread. That's 9%. That's really, really good. What does the numbers look like? Well, on the $10,000, they paid me $100, and through the loan that they created for someone and the money that they loan out, they received $1,000. So there's actually a $900 profit there. But there's one thing that was missing, and that was the thing when I look closer, I'm like, well, wait a second. I put the $10,000 in there. They lend it out. What money does the bank have in this transaction? And it was the $100. So they really generated $900 of profits on this, with the only skin in the game that they really had in this very simplified traditional banking system model was the $100. So that's actually 900% profit then if you want to look at it. And now if you want to include fractional reserve banking, you know, where traditionally, even in that system, banks would have to keep 10% of reserves within the bank. The rest of the money they can just make loans with. Now you're starting to add more zeros to that profit. So it's very, very profitable. It's a very powerful system. So when I saw that, I said, well, I've got to figure out how to become the bank. I have to figure out how to become a bank because they have a constant flow of deposits. They position their capital efficiently. If you really look at the operations of most banks, they collateralize assets, which I will get into, and then they generate more cash flow by making loans. And of course, there's multiple products that they're selling on the other side. And then the money comes back. So there's a constant flow of money into the bank and out of the bank and then back into the bank. So I came up with this very simplified model, and this is what we teach, the framework that we utilize of everything that we do. And just over the past 20 years since I bought my first real estate property and interviewing amazing, very wealthy people and on my show and so forth, it really came down to 4 pillars, what they actually do. They make money, cash creation, as I call it. They protect their money. They position capital effectively because money has to reside somewhere, right? So I call that cash capture. And then they deploy cash after they position it effectively and efficiently to generate cash flow. And the money flows back into the central piece, which is the cash capture, their quote unquote bank, right? Their personal bank, family bank, or their business bank. And then the 4th pillar is cash control, which is one of the most important pieces of it. That's why I have it at the bottom, because cash control includes taxes, right? Very, very wealthy families, if you look at family offices, spend the majority of their time figuring out how to reduce and limit taxes legally, because they know if they reduce their taxes by 15 to 20%, there's no return in the marketplace that's going to pay them that, right? So they control when they pay taxes and how much they pay in taxes. They have asset protection because they know, especially in the United States, you don't have to do anything wrong to get sued in this country. So they have a focus on asset protection. And then there's estate planning, proper estate planning, setting up this family office structure through proper estate planning. So where do we warehouse cash? Because I mentioned cash has to reside somewhere, right? So you make your money, where do you put it? And before you deploy it as part of the system. So some of the things that we look at is, one of the most important thing about money is understanding that you have to maintain control over it at all times. I just look at what's happened during this past 2 months, and everyone that has control over their capital in our network and position effectively has been weathering the storm pretty well, and they're still running. So it's very important to have control over it, to have use over it, and liquidity to be able to access capital. A safe harbor. Here's one of the other things that I've learned spending time with some very, very wealthy folks and speaking with folks in family offices. The ultra wealthy are very much more concerned with protecting money from losses than the average person. It's quite incredible. But that's, we've all heard the quotes, and we can throw out probably 10 or 15 each about, Warren Buffett saying rule number 1 of investing is don't lose any money. Rule number 2 is follow rule number 1. There's many of them out there. They really are obsessed about not losing money because they know that money is never lost. It's simply transferred. So it's just moved to someone else. If money was lost in the stock market, which about 30% of gains was wiped out, yeah, it came back a little bit, but that 30% of money it didn't disappear. It just exchanged hands. It went somewhere else. So safe harbor, no loss provisions, tax-free growth and distribution, the control over taxes, when you pay taxes and how much you pay in taxes, a competitive return, to be able to put as much as money in there as you wanted to and not be limited to that, right? That's where a lot of IRAs come up short. Collateral opportunities, which I'll talk a little bit about, which is very, very important. Guaranteed loan provisions, which is also very important, especially in an environment like right now and the environment we're about to go into. Lending is going to be very tight. So that's very important. Unstructured loan payments, which just ties into control and additional benefits. So let me share some quick examples quickly with collateralization. And what collateralizing an asset simply means the following. And I was a former rugby player, so I got knocked in the head a lot of times. So I try to keep things very simple for myself to understand. It simply means using one asset to acquire another asset. without selling the asset that you leveraged. So when we talk about collateralizing assets, we look at businesses, right? You can collateralize your business through credit lines and loans secured by equipment, business assets, and receivables. So an example was someone in our network had a business. They collateralized the receivables and some of the assets of the business to actually get a loan to purchase the real estate from which the business operated. So they actually used their business to buy real estate without selling the business. Real estate, this is your domain. So you're very well familiar with HELOCs, right? And refis, cash out, to keep the money rolling into other properties. So you're basically taking one property, accessing the equity in that property, and then acquiring another property with it, collateralizing one to acquire another. Stocks as asset-based lending, right? There's certain portfolio loans that you can get from certain investment banks secured by a portfolio of stocks. Very risky. I don't endorse that at all. It's not aligned with my risk profile, but that is something that people do. Savings, there's loans that can be secured by CDs, certificate of deposits, right? Certain banks would issue you loans secured by the CD. So I actually, the first time, I'm originally from South Africa, I couldn't get credit cards even if I begged when I first got here because I didn't have any credit established. So I had to basically put a CD in a bank, which they then issued me a credit card. That was some sort of form of collateralization, right? The money for the credit. Permanent life insurance, which we'll get into, whole life insurance, is secured by the cash value and death benefit. We'll touch on that. Gold and art is great commodity-backed finance, which is a great strategy, especially right now where a lot of people have gold, so and silver. And yeah, you can use your gold and silver to acquire other assets. And cryptocurrencies, there's also asset-based lending done by certain crypto platforms. There's actually a company in the space that are doing that where you can get loans secured by your Bitcoin. These are also, by the way, when you're having conversations of raising capital from investors for real estate, if you're looking to provide value to potential real estate buyers, and if they're trying to figure out where the money's going to come from, these are maybe all conversations to have with them, because maybe someone's sitting on a mountain of cryptos and they don't even realize that they can leverage that in other ways as well. So I want to talk about this quickly. I had a coach circa 2003, 2004. What they did in the 70s was actually very simple. This is a great example just of collateralizing an asset. Is they would go to the bank and say, Mr. Banker, can I put money in your bank in a CD? And the banker would say, of course. We love a constant flow of deposits. Again, right? So they would put 100K in there, and let's just say they paid them 10%, which they paid double digits, I believe, in the 70s. They would go back to that same bank and say, Mr. Banker, I've got 100K in a CD in your bank. Can I get a loan that's secured by that 100K? And the banker would say, well, we like a constant flow of deposits, but we also make loans. That's our business. Of course, we'll give you 90% of that 100K in a loan. And let's just say at 8%. Even if they gave it to them at 10%, it's still fine, because the power lies in the cost of capital here. The cost of capital for this investor there, let's just say, was 8%. He now takes that money that he received through the loan, he invests in real estate and get a 15% return. The other pays back the cash flow, or the cash if it's a flip or some other type of deal that he's doing. What happened in this transaction? The 100K was growing, right? Still earning 10%, even if it's a couple of years. You never touch that money, but you were able to borrow against it, invest in real estate, pay it down, and eventually you have the real estate and you still have that CD. That's collateralization right there. Now, there's even a better way of doing it, which I'll share with you. The reason why we use life insurance, and this was one of the other things that just really blow my mind when I came across it, is because it checks all of the many boxes of the collateralization vehicles, but also offers even more than that. And that's why it's utilized just as this in family offices and by very wealthy investors. Life insurance, a dividend-paying whole life insurance policy with a mutual insurance company checks the boxes. So there's a couple of things I just wanted to clarify there. So it's a dividend paying whole life insurance policy. It's structured very, very differently than the retail insurance policies that are sold, the ones that Dave Ramsey and Susie Orman hates. Because again, as you all know, real estate investors, let's just say there's one property, one real estate investor loses money on that property, another guy comes in and buys that, or gal, and turns it into a cash cow. What's the difference between the two, right? Most likely, besides for the experience and the timing of the market, we could really get down into the weeds, but essentially what it comes down to is strategy. Different types of strategy. So everyone is the exact same vehicles to invest in and utilize and leverage. It's how you do it. Essentially, if you break it down, there's businesses, there's real estate, there's commodities, there's paper assets, there's crypto, and I mentioned real estate. We all have the same asset classes essentially to leverage and utilize, all of us. There's not a secret asset class that nobody knows about. It's how we implement and execute strategies utilizing those vehicles and the tools that are available. So I just wanted to share that. So it's a little bit differently structured, which we'll get into. Mutual insurance companies have been around since the mid 1800s. They're not listed on stock exchanges. So they're managed on behalf of the shareholders, which are the policy holders. They're some of the top rated and most sound financial institutions in the United States right now. It's very interesting for me personally to see, being on the inside of the industry too, to see what's going on and how powerful these companies are, because as there are companies panicking and freaking out, these companies are just plugging along without batting an eyelid, and the world around them is pretty chaotic. So it's been pretty impressive to see that. So why do we use that vehicle and that tool? Because essentially it's a tool, right? You have immediate access and control of your money. So if you fund premiums into this policy, you have access to it immediately. So usually when you cut a check and pay the premium annually, within the first week, you'll have access to money that's in there. And the way that we structure the policies is, of the premiums, 70% or more, depending on age, underwriting, and so forth, is available in cash value. So you'll have access to approximately 70% of the premiums that you put in within the first week. There's guarantees on the principal and growth. So about 4% tax-free over the life of the policy. So I just want to state that, because tax-free growth, to get that type of return pre-tax, you're looking at 8%, maybe even a little bit of more than that, just to get that in the marketplace, and you have to actually risk your money. They pay annual dividends of the 6 to 7% range. Right now, the dividends with some of the carriers, one of the carriers that we use is 6.10%. It's kind of crazy in this very low interest rate environment where folks are not finding any place to just put capital that makes sense. And this is also tax-free. We've mentioned the tax-free growth and access. There's no contribution and distribution limits. So it's not like an IRA where you're only allowed a certain amount of money to put in there every year, or solo 401ks, or any of these other qualified plans. These life insurance companies will underwrite you based on income and your assets. And usually the rule of thumb is they allow you to put a 25% of your annual income in premiums into the policy. There's also no distribution limits. You can access your money at any time. We'll talk about that in a second. But also, there's no rule saying you can only access this and you have to apply. I mean, it's literally a one-page sheet that you fill out, send it to them, and they send you your money. It's a private contract. So policy loans, which we'll get to, they don't pull credit. It's completely private. Nobody knows that you have this. By the way, asset protection in all 50 states in some shape, way, or form. If you're in Pennsylvania, it is protected. Cash value and a whole life insurance policy is protected. So we're living in a very litigious society to begin with. I think it's going to become much more litigious in the next couple of years. It always is in downturns. So this is very, very important, especially of a lot of the folks on our network that are high net worth folks and high income earners, doctors, lawyers, and so forth. You have a bullseye on your back constantly. So lawsuits, if there's motor car accidents, or you pick the situation, people are going to try and go after you, and this is a great place to have that. Collateral opportunities, we talk about collateralization, guaranteed loan provisions. So unlike HELOCs that can be pulled, you have a guaranteed loan provision. So during this crisis, I had to pay money to a mastermind that I belong to. And I sent in basically, I one-page sheeter, sent it in. I got my check four days later during the midst of basically a crisis that was unfolding. This is about 2-3 weeks ago. So it was still pretty crazy. It still is, but it was even crazier initially as people were trying to figure out what was going on. So it just shows you they didn't even bat an eyelid. And I was able to get access to my money. Funding continuation, you can throw a disability rider on there. There's some long-term care provisions. So if something happens to you and you become disabled, the company picks up the premiums. So there's, again, risk management is huge for wealthy individuals. And then this is one of my favorite ones, right? So as you build things up in your life, right? You build your business, you're making money, you're making investments, you're creating different streams of income and cash flow income streams, and you build all of this up. At the end, what is it for, right? So besides building this legacy for your family, you want to be able to transfer it over to them, right? That's one of the most important things. The exit strategy of doing all of this is you produce and create all this value in your time on this spinning ball of dirt. But when you go on to wherever you're going after that, you want to leave something. You want to leave something to the family. You can do that, and it provides a death benefit, usually a multiple of the account value, which if you compare that to a 401k and any other qualified retirement plans, number one, you only get what's in there. Number two, the beneficiaries are still going to get hit with taxes, right? So the policy within the system is the primary savings vehicle. It's not an investment. It's a savings vehicle. It's simply a place to put your capital. You know, it reminds me of one of our clients. He had about $1 million that he was deploying, and about 800,000 of that he was deploying in an investment that was paying him 10%, right? Great stuff. $80,000 per year he was basically getting on that. But there was $200,000 just sitting somewhere doing absolutely nothing. What if he got 4% tax-free on that money? What does that do of his overall picture? Again, we didn't change what he was doing, how he was making his money. We're not going to make people better business owners or better professionals. We're not going to make people better investors. We're going to tweak and put a little rocket fuel on what you're already doing just by moving things around a little bit and making one or two small adjustments. So the policy, as I mentioned, is a dividend-paying whole life insurance policy with a mutual insurance carrier. It's structured for maximum cash. We talked about the 70%, and you get access to that money right away. So this is essentially a nice, I would say, chart that just shows and diagram that shows you just basically essentially what you're doing within this system. So you're going to make your money, you're going to put it inside of this vehicle, this high cash value life insurance that's structured for maximum cash, that's going to earn dividends, grow tax-free, compound, and then you're going to leverage that money through collateralizing the cash value in the policy, acquire an investment or invest in your business, right, which is a great investment, and you're all building your businesses that generates cash flow, whether it's an ad campaign that you're running or whether it's another real estate property that you're buying. It's generating cash flow, and then the cash flow is then used to pay down the policy loan because it operates like a credit line. There's no limit to the amount of policy loans that you can have. So the policy loans is usually at 5%. We'll get to that. But yeah, 5% interest only is the policy loan rate, which is based on the Moody's corporate bond average yield. It's variable. It's not locked in. I always say that insurance companies, essentially, their business is risk management. That's the business that they're in, right? And if you're getting a fixed rate for the rest of your life from an insurance company, there's no deals in insurance. It's simply math. There's got to be something else on the other side. The rate has been varied since 2007 between 5.75 and around 4.75. So about a percent, because that's a question that a lot of folks ask. So it's not very volatile, jumping up and down and all over the place. So this is just how we utilize it for real estate, cash flowing and real estate, using the policy for real estate. I want to share this quick case study with you. So This is someone that came to us, about a 40-year-old male, and his goal was to make about $360,000 in passive income. He was all about mobile home parks. So he wanted to invest in these syndications. There's this fund that was paying him a preferred return of 8%. And his goal was to allocate about $200,000 per year towards that and getting that done, which is awesome, right? So what would be the results if he just does that? So without reinvesting the cash flow that from that, or the returns from that syndication, it'll take him about 22.5 years, and he'll have $4.5 million deployed at 8%. That's $360,000 per year. Again, we didn't reinvest yearly cash flows from the syndication. If we did, it would take about 11 to 12 years, if my math is on. The passive income goal, he achieved it. It's phenomenal. I mean, this is great stuff. There's nothing wrong with this. This is really, really good stuff. So that was his plan, and that's what he wanted to do, and that's what he allocated the capital for. So we took a step back and we said, okay, what if we did this? What if we ran this through a policy first, right? We funded a cash flow infinite banking policy first with that $200,000, and then we invested it into the syndication. And he was open to it. So we explored it for them. And we said, listen, if we didn't reinvest the returns from that syndication, it's not going to be that massive of a difference in the time that it's going to take, right? About 20 years, you'll have 4.5 million deployed, which is $360,000 a year in passive income. If we reinvested it again, it's going to be around about the same time that you're going to achieve that. So it's not going to change significantly what you're doing right there, right? But there was one thing that was quite amazing when we realized that when positioning capital a little bit more efficiently and effectively, and then utilizing it and leveraging it, that happened. And that was, he had approximately $1.46 million tax-free extra in his policy after deploying 4.5 million. And then he had a death benefit, of course, on top of that to transfer liquidity efficiently to the trust that he had. So all we did was just took the money, positioned it for him. He was already, he was doing the exact same thing, but because we positioned it efficiently, we made him the bank. So there's money flowing in, and there's money flowing out, and there's money flowing back in. Positioning himself as the bank, he had an additional $1.46 million approximately. So, and that's a lot of money. And that's tax-free. There's no taxes paid on that. So that was just phenomenal to look at. And you have to look at it as an opportunity cost too, right? So eventually that's what he looked at it. He said, so what you're telling me basically is my cost of not doing this over the course of 20 years, because that's what we look at. We look in terms of 20 to 25 years in planning, just to see get the big picture view. The cost for him of not doing it was 1.46 approximately, very, very close. So, and there's a death benefit of multiple cash values. There's a disability waiver of premium, by the way, that we put on it. He was a very high income earner. So what happened if he got injured and he could no longer do what he was doing to earn the money to fund the policy? Well, he had the disability waiver of premium on there, the rider. So the insurance company would have kept on paying the premiums for him. So, and he's in Pennsylvania, so he had some asset protection too. So there's a lot of things that it did for him. And all we did was just position capital a little bit more efficiently. So that's one of the things that I want to drive home with everyone, because especially right now in the environment that we're in the environment that we're going to move in when we come out of this, it's going to be more important than ever to understand exactly where your money's at, who it's with. There's going to be huge institutional risk too, not just what it's in, but where it is at. And that's why I sleep at night knowing that it's in mutual insurance companies. So real estate and life insurance is essentially very, very, very similar assets. And I know I get some eye rolls when I usually start talking about this, but essentially with both of them, you have a mortgage, right? You have a mortgage that you pay for a specific period of time. With life insurance, you have premiums that are 5, 10, 15, 20 years that you pay. The mortgage you pay off, you own the property free and clear. The life insurance, you pay all the premiums, you own the contract free and clear. When you make payments towards a mortgage, principal and interest, you build up equity in a property. The same thing happens with a life insurance contract. When you pay premiums, it just happens a lot faster. That's why that's the place where we store the liquidity, is you build up equity in it. You can access the equity in real estate, let's just say through a HELOC, a refi. You can access the equity in life insurance through a policy loan secured by the cash value. Another thing that is phenomenal is, when I bought my first property, it's about 20 years ago, and I paid all of the bills associated with it after my tenant gave me the check, and I had money left over at the end of the month. I'm like, this is amazing. Cash flow, positive cash flow. How many times can I do this? So it provides cash flow. The same with a life insurance contract, where the insurance carrier pays all of its expenses, and these mutual insurance companies have been very profitable for years. And at the end of the year, they distribute the profit of the company to the shareholders, which is the policy owners, in the shape of dividends, which is tax-free, by the way, too. So that's a cash flow in a life insurance contract. And then there's appreciation in both of them. So real estate, if you do it properly, especially with investment real estate, the property appreciates. With the way that we structure these contracts with life insurance, the death benefit appreciates too. The value of the contract appreciates because the value of your earnings and your production and creation increases as well. So it's got to keep up with that. And then, of course, the tax advantages in real estate. I'm not going to dive into that. You guys and gals all know that. But that's phenomenal. Also, the tax advantages in a life insurance contract is quite incredible. So this is after, you cannot write this off, by the way. Premiums cannot be deductible. So this is after tax. You control how you pay taxes. Then you put the after tax dollars in a vehicle where it grows tax-free. You can access it tax-free. You get tax-free dividends. And then eventually you could get a tax-free, quote unquote, pension in this contract. So the way that we structure it, we know, it's 55, 60, 65 and 70, there will be an tax-free income stream that you can draw from that policy to supplement all of the income that you're getting from your real estate, which is quite incredible. And then when you pass away, the money is transferred tax-free to your estate and your beneficiaries. We talked a little bit about controlled leverage and inflation hedge on both of those. By the way, two asset classes that banks will borrow money on is real estate and life insurance. Most people know about the real estate. Life insurance, there's a strategy called premium financing. When you have a certain net worth, banks will actually lend you money, and financial companies will lend you money to buy real estate, life insurance rather, for the premiums. So, and then, one of my other fun things that I throw in there too is, with real estate, you can actually sell notes. We have folks in our network, Mr. Dave Van Horn, the note guy in the Philadelphia area. We have folks that love mortgage notes. Well, with life insurance, contracts can be sold as well. It's called life settlements. So there's a lot of similarities. The underlying asset is different, but it's very, very similar stuff, how the wealthy utilize life insurance and real estate. I just want to share this with you quick. When you're your own bank, you start to do things that you didn't even think was possible. So this is someone in our network, right? So they had some debt, massive student loan debt, medical professional, huge student loan debt. So what they were able to do, instead of just paying the debt off with the cash, then the debt is gone and the cash is gone, what did they do? How can we do this better? How can we become a bank and be our own bank and pay this off more effectively? So we looked at what they were doing, and again, they're crushing it with production and creation. They're producers. We're not going to change that, right? What we can do is just restructure a little bit, tweak the cash flow pattern and make them their bank. So we set up the policy for them. So instead of just taking the cash and paying off the debt, we structured a policy to set up their bank. So now they're paying the bank first, paying themselves first, which if you haven't read the book, The Richest Man in Babylon, it's quite incredible. And it's such a small thing that changes your complete mindset on your life. Once you start paying yourself first, you now have prioritized yourself, your family, and your future, and put the banking and financial institutions in a different, made them a different priority and made yourself a priority. So they paid themselves first, put it in the policy, then they invested in a cash flow producing asset, which then this particular asset not only paid for the debt, but also paid some of the policy loan back. So essentially looking at the numbers for them, in a couple of years, they're going to pay off that debt and still have their banking system set up, returning money back into their own economy instead of sending money to the bank's economy, and they're going to have the asset. So they acquire two vehicles and two assets and paid off a liability just because they positioned themselves as the bank. So I like to call this vehicle the and asset too, because it's you don't have to choose between this or the other one, right? That's why I love this asset in combination with real estate, because I don't have to choose between real estate and this. I can have both. And, when I was a kid, I like more than one a scoop of ice cream, right? And different flavors. So same thing you could do with this. Just want to recapture, this is the system that we've utilized, and that just from over the past 20 years of putting it together, keeping it very, very simple, but those four pillars of making money, protecting and positioning capital efficiently, then deploying it for cash flow to invest it, having the cash flow return back into my own economy, and then cash control is having control over when you pay taxes, how much you pay in taxes, protecting your assets, controlling that uncontrollable, and then also proper estate planning is in there too. Once you also structure a banking system efficiently and effectively, there's a lot of other cash flow that you can recapture within your own economy. I'll give you a couple of quick examples. So if you have about 6 to 12 months in cash, which we recommended last year, we were very, very big on all of our clients having at least 12 months. We usually say 6 months, but we thought that it was going to be a pretty volatile year, 2020, with an election coming up, the longest economic boom the United States has ever had. What happened? No one saw coming. We didn't either. But having that in place, right? So let's just say you had 6 months of cash reserves in your own banking system. Now, all of a sudden, you can raise deductibles on other insurances, because insurance should replace the loss when there's catastrophic loss, right? If there's a fender bender on a car, it doesn't make sense to file insurance claims because it's only going to raise insurance costs. If you've structured properly, the money that you're going to be able to recapture with raising deductibles is going to be much more in the long run. For sales professionals, and especially high income earning professionals, disability insurance is a big one too. When you have 6 months of reserves, then all of a sudden now you can raise the elimination period, which is a time deductible with disability, which have saved people in our network thousands of dollars monthly and annually. So just by positioning assets efficiently, now all of a sudden there's other ways that you can recover even more cash flow, paying off bad debt and repaying it back to your own bank, restructuring different loans. So it opens up another world of opportunity, which creates the snowball effect in essence, which is something that is just, I love that kind of stuff. When you see something going and it just picks up steam, and it's going to help you look also like, what can I do better? What's more efficiently? How can I position this more effectively and efficiently? If this interests you, and I'll pause for a couple of questions too from you guys. There's might be a lot of other questions that you have from this presentation. I put together a video series that you can access at yourownbankingsystem.com, yourownbankingsystem.com. I think we have about 6 videos, but it walks you through. We go into detail into case studies, what these policies look like, because there's different types of strategies for different folks, right? There's people in different parts of the journey. You might be young with a lot of time, not a lot of resources, and just starting to make money. You might be in your 30s, 40s, and 50s where you've got resources, you've got a lot of time, and you're making really good money that you're trying to deploy better, and you're building out your net worth, right? And then there's also different strategies for folks in their 60s and 70s and 80s. We do a ton of children policies, which is amazing for families building their banking systems, grandparents purchasing policies, and so forth. I go into all that and much, much more case studies on investor stuff, more case studies on paying off debt, and then also share some business examples, because if you get into researching the stuff, besides premium financing, there's bank-owned life insurance, BOLI. There's corporate-owned life insurance, which is huge with corporations. You Google Jeffrey Immel, GE life insurance. You Google Jim Harbaugh, University of Michigan life insurance. You'll see some stuff. This is very, very much aligned with what those strategies are. If you want to have a chat and see if it's a good fit for you, you can reach out to me, strategycallwithmc.com. That'll take you to a booking page, and my email is mc@mclaubscher.com. So I'll pause for a second. If there's any questions, I'll be happy to answer them for you.
Hey, MC, I got a couple I can ask.
Sure.
So on the interest rate piece, I know that, so it's like a 5% interest when you take the money, you loan it to yourself.
Yep.
Does that 5% interest come back to our account?
That is a phenomenal question, because there's a lot of misinformation on the internet about that. So no. So what happens is your policy, the cash value in your policy stays, it grows at the guaranteed rate and receives dividends. The policy loan actually comes out of a separate account from the insurance company, a general account, and the interest is repaid to that general account. It's not going straight into your policy. Now, how do you benefit from that by doing that? Well, the company that you're money with, it's one of their profit centers too, and you get to participate in the profit from policy loans and all the other investments that they're making through dividends. So it doesn't necessarily, I've seen a lot of people talk about borrowing from their own bank, taking it and repaying their own bank. It's not necessarily the case. It's two different transactions.
Gotcha. That makes sense. For the investments, that was one of my other questions. Are you able to pick more aggressive stocks based on your plan? Because, I guess that's the question. What are they investing in, and are you able to, pick your aggressiveness with the money?
Yeah, that's also a very good question. So a lot of our clients are into different industries. So we actually work with Wall Street traders too, and options traders. And, the conversation goes as follows. MC, I'm in the casino. I'm doing some stuff. It's very, very lucrative. It's great, but I just need something that's certain, something that's foundational, something to fall back onto. So for them, it was great, because they basically said, we did a different strategy for this particular individual, where they just said, when I'm 60, I want X amount of money, tax-free, and my own quote unquote little private pension from an insurance contract. How much do I need to fund those policies with every single year? And for them, they didn't even plan on touching it and utilizing it ongoing. They just wanted certainty in an uncertain environment that they operate in daily. When it comes to stocks, so there's actually a lot of what we've been doing is we call it the kind of like it's sort of like the retirement. What did we call it? The retirement rescue sort of strategy. And what it is when people have qualified retirement plans, right? We can actually put this together, take some of other resources, position it more efficiently and effectively, so that when they start to go into retirement, let's just say they went into retirement this year, right? This is a good example. Well, your account balance has just been drawn down 30% in your qualified retirement plans. So now you're like, oh my goodness, like I don't want to pull from that money because I'm down. Now I'm pulling it down and then I'm trying to make it back up. What can I do? Well, if you had this would be a good year to draw money from your insurance policy and then just let that money then sit there, obviously with the hopes that it's coming back. So there's many different strategies. Yes. Can you be more aggressive in certain things that you do because you have this? Yes. The other thing that I would also say is, for me, speaking personally for myself, this has made me a better investor and business person, because I understand my cost of capital much better, which I didn't, 20 years ago. So the over 10 years that I started with this ago, I have realized that, okay, 5% is my cost of capital. It has to make sense to deploy this in this strategy in my business, because I need to see that return, right, on that for it to make sense. It needs to make sense in this investment. So there are some investments that I would pause, which maybe the younger guy in me would have jumped on. But knowing my cost of capital is 5%, now I'm like, well, I'm just going to sit because I'm getting 4 to 5%. I don't have to do anything really. I'll wait for the right deal, which ties into, it's funny, I interviewed Jim Rogers last night, and one of the things that he shared with me, because a lot of people are asking him, should I be buying this? Should I be buying that? Should I do this? Should he do that? And this is one of the greatest pieces of that I've learned from him, was he said, MC, what if you can only make 20 investments in your entire life? How would you go about picking any investments? He said, because really, he said, I'm an old man, I've done well, but if I had to look at the investments that I made, it hasn't been a lot of investments. It's really about you can nail it down to a couple. He said, so pick a number like 20. If you had to make 20 investments, how would you go about doing your due diligence, knowing that those 20 investments will set you up for the rest of your life? I'm trying to think of.
Quick follow-up question to that. This was something when I first started looking into these policies. Allstate said you could choose the aggressiveness of the investments they make through your policy for that guaranteed rate. Is that possible?
Those are two different things. So that's another good question. So that's universal life. And we stay away from universal life, because what universal life is it's a renewable term insurance, which is then combined with a basket of like stocks, basically equities, right? So there's different types of universal life policies. There's variable universal, there's index universal, but you're still there. There's a lot of things wrong with it. One of the things is your insurance isn't locked in and level, your premium. And what I mean by that is a renewable term, like term insurance. There's a time and a place for term. It's not either or. A term is for a specific term, a period where you are insured, that you pay the insurance company premiums. So for example, let's just say, I pay him $1,000 and I get $500,000 in death benefit. And I'm going to pay that $1,000 for 20 years, right? So I'm going to pay them $20,000 over 20 years. And if I die within those 20 years, my family, my beneficiaries get 500,000. If I don't, they keep the premiums. That's term. What they did was combine a renewable term, which renew at the age that you're at every single year, and combine it with equities. So what you're hoping on basically is that the stock market keeps going up, 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 up as your cost of insurance keeps going up. So that's why they fall apart in the back end. If you Google universal life lawsuits, it's all over the place. There's been companies like Voya that have stopped selling it because it's been such a disaster for a lot of insurance companies. So it's been a black eye for the insurance industry, and rightfully so, very well deserved, because there was a lot of, there was a lot of things that wasn't structured correctly. So when you're in your 20s and 30s and early 40s, yes, it might make sense because your cost of insurance is still low. But when you get older, now it starts to really climb. You look at term insurance costs for 50s, 60s, and 70s. I mean, it becomes unaffordable. So if you ever heard that somebody had insurance and the insurance became unaffordable, or their parents had insurance and it became unaffordable, that's kind of where the whole thing about people were angry at one stage, and you started seeing stuff in newspapers about insurance companies not paying out. Well, what happened was mom and dad had insurance. They got older. These policies, it became unaffordable. They let it lapse, right? They let it go and it went away. And then mom and dad passed away, and the children said, where's the money? Because they had these insurance policies. Well, what mom and dad never told the children was that the policies lapsed. So, Yeah, so it's a little bit of a different, that's different. We specifically use a dividend paying whole life insurance policy with a mutual insurance company for infinite banking because it doesn't have that moving element. You structure it initially and it stays steady. Your premiums are going to stay level throughout your year. So if you start when you're young, and let's just say your premiums, let's just say you put in $10,000 a year, right? Which you would have close or over 7,000 available within year one. Let's just say you put that in. Well, it doesn't increase every single year. That $10,000 a year when you're 23 or 24 is $10,000 a year when you're 50, 60, and 70. So it becomes much more manageable, and it's all about control. It's all about control. It's about having a solid footing and a solid foundation. And that's why we like this one too. The other product to universal life policies has been around like since the 1980s, right? It was really an effort of the insurance industry to get in on the boom that Wall Street had because of the 401ks. 401ks was created in through the ERISA Act in 74. Some of the first ones was created in 81. I just interviewed Ted Benna on my show. He was the creator of the 401k. It's talking about the 401k 40 years later. That caused a massive stock market boom because a lot of people were not invested. Most Americans were not invested in the stock market. And then all of a sudden through 401ks, the majority of the country was invested with them. There was a massive boom. They tried to get in. That's why that product was designed. The whole life policies have been around, since the mid 1800s. So it stood the test of time.
Yeah. So I asked that question for two reasons for all the people watching this. I've actually talked to 8 insurance brokers who have set up a whole life policy for me incorrectly, sent me a quote, and then I've sent it around and people said, whoa, that's not the correct product, or they totally misled me. So this is a specialty product. And insurance brokers, and a lot of us know this because we're shareholders of an Allstate insurance office, they make a lot of money on the life insurance. So they may crank out a policy that's not correct. So make sure you're using specialists if you look into this. And I think the other important part of it, correct me if I'm wrong, but I like to have access to my money. And pretty much the only advice that any very basic accountant will give you is, open up a SEP or an IRA. And I personally feel that that's not the correct option. And I think that money's a lot harder to get access to. Which is why I started exploring whole life, and thank God found MC because no one else set this up correctly. The way this policy was set up, I sent this to my financial advisor, and so did Carl actually. And he sells insurance too. And he saw the policy and he was like, go with him. That guy set it up perfectly. And they broker or they use Penn Mutual as well. And he said, no, go with MC. He set it up the same way I would. So that's important too. Make sure you have an honest team behind you. Because my guy could have easily said, screw MC, sign up with us. But he said, no, that guy set it up. He put in the work. This is exactly how your policy should be. And again, I say that because it's important. 8 people have set it up incorrectly for me. So.
One other thing that I would add to that too, John, and I appreciate you sharing that, is I did a video on this too on one of my podcasts because we get a lot of folks asking us, let's balance it out a little bit. How could this backfire, basically? And what you touched on too is it has to be set up with the right agent, somebody that knows how to structure it with the right company, and it has to be structured a specific way. And then also what is very important is you want to have someone on your team that can help you and guide you utilize this, because policy management also is you can have the best structured policy, but if the policy is mismanaged and not correctly used in this manner, then you're going to run into issues. There's certain things that's not going to do what you want it to do. So you don't want any surprises. So you want to have someone on your team that can help you manage through this, talk about different scenarios, strategies, and so forth. And and the comment on the CPA too. What we always say and what I found is, when I just relate a lot of things to sports. You have you start playing sports a little league, right? And then you get to high school and you have coaches along the way. So, and I've had some amazing, amazing coaches at all levels in my life, in the sports that I played, whether it was in high school, amazing coach, great mentor at that stage, preparing me and then getting me ready to get into college and getting a college scholarship, and then playing at a high level in college to eventually get to the next level, right? To then eventually play in the pros, whether you go to the NBA or the NHL or so forth. So they all do their thing, but they do it at different levels. So you have to be very cognizant that you're working with, let's just say, CPA in this instant too, that is playing at a certain level that you aspire to play at, and someone that's going to pull you up basically and raise your game. You know, an example with the taxes, right? There's many different strategies that you can utilize just to reduce taxes legally that a lot of folks would run, a lot of CPAs, if it's out of their comfort zone, they would say, no, you know, that's not a good idea. But in effect, and one example is captive insurance strategies, right? For a lot of business owners, where some CPAs would run away from it. But then I look at what some of the guys do that's playing, you know, at the Pro Bowl, some of the firms, and they're utilizing it. Their clients are utilizing it. So that's one piece that I would also just share from my personal journey and experience.
Yeah, I always say, don't take advice from someone that you wouldn't trade lives with, and because everyone's quick to give it to you, and a lot of times it's not correct. Overfunding the policy, I hear that term a lot, and I also it throws me off only because I know that initially for the policy I could say, hey, MC, I want to give you $100,000 initially for my policy, and can I do that also in the middle of the policy? Can I change, you know, how much I fund per year, or can I just hand you one lump sum to avoid taxes into the policy? Can you do things like that?
Yeah, those are great questions. So overfunding just means overfunding the initial base premium. So what it means is when you structure these policies, there's a base of the insurance, right? Of the whole life insurance. Then we add another rider to it that reduces the overall cost of insurance. And then the overfunding comes in with basically we add a rider, which is the savings element, if I want to put it that way, paid up additions rider. But the way to look at it is that's actually the part that drives the cash growth. So overfunding simply means is you're paying the insurance and then overfunding it into this specific little part of the policy, which brings up the cash value. So when you look at just traditional policies that Dave Ramsey and Susie Orman hates, they would put all the money in the base, that part of the insurance, and there's no cash value available for years in those policies, right? And then when you structure the policies, let's just use the 100,000. So let's just use the 100,000 basically. So if you do that, let's just say 30 would be in there. Let's do a 30-70 split just for simple math. So that means 30 is the minimum and then 100 is the maximum. And how we structure it is from maximum cash value, right? So the max would be 100 to put into that policy. And we cannot make changes later. Personally, what I did, because your journey changes, right? So you start with one, your income increases, your net worth increases, and then you add another policy. You know, I looked at it many different ways. There's some folks that would roll policies into one another, which is not cost efficient because you're basically restarting the whole process of building up whole life policies. So I'm not a fan of replacing policies from a principal standpoint. So what I did personally was stack the policies because they're all structured for maximum efficiency and they're on top of one another. So I know from a cost standpoint, because that's the big part of the efficiency is you want to reduce the cost as much as possible and build the most efficient policy for short-term, medium, and long-term growth and have a solid policy. So yes, you cannot make changes once it's set and it's there. There is a minimum, there's a maximum. And then the other thing that I would also share, because here's another frequently asked question, MC, what happens if we're struggling to, in this example, let's just say to make that 30 payments, right? Because you can put up to 100, but you want to put in 30. And again, you could just switch out, take zeros away if you want to, but let's just stick with this example. There's a couple of things that you can do that are options for you. So This happens, by the way, more than often with a lot of folks on our network, because business owners and investors, it's feast or famine with liquidity. Sometimes there's a ton of liquidity coming in, and other times there's a ton of liquidity deployed into assets, into projects, into business projects, and so forth. So this happens quite a bit. So what can you do if somebody said, MC, I'm running low on liquidity, I've got all this money on the street and projects, what are my options? So the first thing is you can actually pay that monthly. You can pay the minimum monthly and spread it monthly, quarterly, annually. That's one way. The second thing that you can do is you can actually take a policy loan, because what we advise our clients to do too is keep a minimum of 6 months liquidity in your policy so that you have something to fall back onto. And when you do that, then there's going to be money in there that you can take a policy loan with, pay the minimum, and then pay the policy loan back and fund the rest of the premiums throughout the year when that liquidity comes back into your system. So I guess what I'm trying to say is there's ways to manage these policies, and there's some ways that are better than others and some are less desirable. So it's each, I would say, yeah, each case is taken separately, and something might make sense for one person and might not make sense for another person. But yeah, so that's kind of the overall structure with that.
So on that same topic, sorry for everyone if I'm asking too many questions and you wanted to ask one, but reducing the rate. So let's say I start off and I'm going to do 50,000 a year divided by 12. And for some reason, I'm not making as much money. Am I able to reduce from 50,000 a year to 30,000 a year?
Yeah. So what would happen in that case? And this is why we've advised folks in some instances to start with a smaller premium amount, right? Then start with a smaller amount rather than a larger amount, and then add another policy eventually when you're ready. Because number one, you want to be comfortable. You want to be in control of your emotions, which ties into being comfortable. Let's use that 100,000 example quick, because this is something that actually we were talking to a client about. So they wanted to put in 100,000, and they were very, very determined to do that. What we said, and we looked at cash flow and so forth, and said, listen, here's what we would recommend. Start with 50 rather, because using that exact same example, 30 would be your minimum on that 100, right? And then your minimum, and I'm just doing numbers here for simple math, would be 15 on that 50. So if you start with a 100,000 policy and you only make a $50,000 payment, you're going to have 20 in cash, right? Available, right? If you make that payment, let's just use that example, which in that case, if you put the 50 in the 50 policy, you would have 35. So if you could only make 50, but you have a 100 policy, you have a 20,000 cash value. But if you started with a 50, using the same kind of math there, you're going to have 35 in cash value. So if you don't fund it all the way up to the 100 initially, because it was very aggressive for the specific individual, you're going to be overpaying for insurance. So yes, would you be able to put in money later into that policy and get up there? Absolutely. Again, it might make sense for some folks. It might, if they know that there's, for example, a inheritance coming in, or a massive bonus, or something like that. It has made sense in the past for some individuals, because we knew that they were going to get there, even if it wasn't in that year, but the following year, let's just say a massive inheritance was coming in. But for most folks, it would make sense. 99% of people, it would make sense to rather start with the 50 and then add another 50 on top of that when they become comfortable, because it's going to be more efficient, and it's going to actually be just the better way to do that.
All right, cool. On the loan piece of it, let's say keep the 100,000. If you take a loan for 100,000 and you made the investor's mistake, fell in love with the deal, and you lose it all, how does that get paid back to the company? What is their recourse?
Yes, that's a great question. So you structure the payback on the loans, which again, it ties into control. You know, usually when you take a loan from a financial institution, it's like, no, you pay it monthly. And if you don't, you're going to know about it. This is, you set the payback period. So you can actually, if there are, let's just say you took a policy loan, you invested in a deal, it was a complete disaster, the money is lost. What happens to the policy loan? Well, the interest then just gets rolled into the loan. Let's just say if you don't pay it back that year, right? And you could pay it back over time. There's certain things that you can do. This is how I look at it, right? So when I take money from my policy and I deploy it and put it into an investment, my goal is, well, my mental approach, my mindset is, okay, I have now some space in our family bank to replenish money. So I look at it, you know, if I had $100,000, let's just say in a bank account, and I make an investment with that $100,000 and I take it out of the bank, I'm going to save money again. Where am I going to put the money? Well, I'm going to replenish my savings in the bank, that 100,000, right? I'm going to do the exact same thing with my policy. The exact same thing. So I take the money out. That's now just become my bank and the place where I warehouse the majority of my cash. Do I still have money in bank accounts? Absolutely. Keep it. You know, we try to keep at least prior to this 3 months of business and 3 months of personal expenses, monthly expenses in bank accounts. Everything else we try to put into the family bank. Now we've taken it down to a month and a month, just because I'm a little bit nervous of the banking industry in general right now, and the rest is in the policy. But what happens to that? You can just tack it on. It could roll on. You don't have to repay a policy loan. Again, from a policy management standpoint, that's not something that you want to do. You want to repay policy loans because you want to keep the system going, right? Money coming in, money going out, money coming back in, and it's a great place to warehouse money, but you don't have to. So when you come to retirement, for example, or people start just taking money from policies, they don't pay it back. So they just draw down cash out of the policy tax-free, and you don't have to repay the policy loans. The interest just gets rolled back into the loan. So that's at the distribution phase stage. So yeah, if you do have a deal and it blows up, it's not the end of the world. If you have a couple of skinny financial months or maybe even a year, yeah, you can just roll the interest into the policy loan and start making some payments back to it the following year. And you structure how much, when, and how much you pay back to it.
Cool. I really don't. I don't have any more questions. I guess just a statement. I thought it was pretty cool because, you know, even if you can't afford a lot on this policy to put in a year, really, and you have to really start small. I thought it was cool because between the death benefit and the cash value, at a minimum, what you can do with this is really leave a large legacy or a large sum of money for, you know, the next generation of your family, if you're looking that far out, which everybody should be. So I thought that was a pretty neat idea and another reason to have the policy at a worst case scenario. So. Yeah,
absolutely. And this is, you know, some folks have probably heard about the Rockefeller method and so forth. So this is done a lot in their family office style of planning, their legacy planning of transferring wealth efficiently to the next generation. There's a lot of strategies just as this, with the trust being the beneficiary and the owner of the policies, and the heirs accessing capital from the estate through life insurance. So there's a lot of that stuff going on. But yeah, it's one of those things that, yes, I also saw there was a minimum. Yes. So a minimum on these policies, we've set them up for $300 a month. You can start small, you can build. My philosophy has always been, you do not have to be a Rockefeller to do what they do. You don't have to be a Buffett or a Rogers or these guys to do what some of them do. If you implement some of the principles and some of the strategies on a smaller scale, it's going to move the needle massively in your own personal economy. So we've set them up for $3,600 per year, $300 a month. We've done children's policy for around about the same, $300, $500 a month. And we've had folks that start with one policy in that range, and then they start adding it on and add one for their spouse and add one for their children, because they start to see, in a small space of time, just the power that this has. We had a real estate investor actually that started with something like this a couple of years ago, and he started with a smaller policy, built it up, kept some reserves, and during this time, he was one of the folks that reached out to us and said, "I just want to thank you for putting this together." And now he's got reserves. And what happened is, as with what's happening with some real estate investors is, people are struggling to pay rent. So he's got reserves in these policies to help them and work through that. So yeah, you can start small and grow with it as you're growing. So I always say, when I started 10 years ago with this, it started with one, and then it started growing, and then that's how you start building up your family bank. Yes, there's another question. Do I charge a fee for consultations? No. So how we operate and work, and that's a great question, by the way. So how we operate and work is, for consultations, no, there's no charge for the consultations. We talk to everyone. How we get paid and how we make money, which is very important to know, is we get paid a commission by the insurance carrier. That's how we get paid. And yeah. There's no additional fees on top of that to work with us from our company, and that's how that works. It was a good question. And we explore, another thing that I'll say with that, we explore and talk. We're a very mission and purpose driven organization. A lot of folks that are on my team are all real estate investors and business owners. From a philosophy and from a principled standpoint, is building out my firm. It took a while to build my team because I wanted investors and folks that have other businesses and have been involved with businesses, because they would be able to provide advice to investors and business owners, right? How can you provide advice if you're not one yourself? So yes, we're very purpose driven and very mission driven, and we welcome all the discussions that we have with people to see if they want to explore this and see if this is a good fit for them.
I came up with another question. So I know the payments are covered for 2 years if for some reason you're disabled. You obviously can then tap the cash value. Would you not have to pay the interest on that because of the disability?
Yeah. So and I have to look at the specific wording in the contract, but there's a certain period of time. So let's just say you become disabled. So there's a certain period of time that they would cover it. And if you become permanently disabled and not go back, then they pay basically the premiums for the policy. On the accessing the cash in the policy, yes, there's certain instances and there's riders on the policy that you can tap into the cash of the policy when you need it later. So there's riders that are called chronic illness, accelerated death benefit, which there's specific provisions in there of how you can access it. I would not personally recommend ever that should be the only long-term care coverage or planning that one has. But there are certain things, other riders that you can add to a contract like this too, which, helps you do a couple of different things. So, there's a presentation that I did where someone said, so, MC, so what you're telling me is this is basically like a Swiss Army knife. There's a lot of different things that you can do with it. And I thought that was a great way of putting it. because there's a lot of different things that you can do with this, and what it does for you. It does something different for everyone, basically, but there's certain things that, regardless of the strategy, that it does for them. So the certainty obviously is a big one because of things like that. Certainty right now in an uncertain world, in an unknown world, is huge. And that might be another question that somebody asked me that the other day, during this time period that we're in, if you look at all the investments and vehicles that are out there and that we have in our portfolios too, what's the one thing that you can count on in a time of a lot of chaos? And it was this. So this was the one thing that we knew that we can count on that's going to be there. It's certain. There's riders in there. So, it's great to have a mindset of knowing that, number one, I have money. I have an emergency fund. Number two, there's a death benefit if something should happen to me and my family. Number three, there's disability provisions in there. And then also number four, there's a tax-free distribution from it at a certain point in time. All of those certainties, that provides how can I describe it? The jump to live abundantly. Because I think once you have clarity and you have certain things in your life in place that provide certainty, now you start living abundantly, because there's certain things that make you sleep well at night. So that's what I would say is like the central thing, and tying into the question of the riders. That's what it provides overall: certainty in uncertain events, because bad things happen to good people all the time. One of the biggest lessons I would also say from this whole experience of what we're all going through and people are globally going through is how unprepared people were for the inevitable. And it's not just individuals, by the way, it's also businesses. How unprepared most people were for the inevitable. And the inevitable was, at some stage, there's going to be things that happen that are out of your control that leads to losses in certain ways, or a very chaotic environment. So this definitely has positioned and help us for that.
What about answering disclosure questions like skydiving or being a pilot? You say initially when you get the policy, you're not going to do that. But then you're nuts like me and you go and do it. And maybe you crash your own plane, or you decide to go skydiving, the parachute doesn't open. Do they then say, hey, you said you weren't going to do that shit on the disclosure questions, and then you did years later, not paying out?
Yeah, I would just say, disclose things up front, because there's risk management models to that specific question. I cannot speak from experience. I've had certain policies where there has been things that have been excluded for high risk activities, such as that. I think the one was flying a plane. So if that happens, then it's not included in basically the policy, because if you have to think of it too, that they would say, yes, we would underwrite you for that, but then the cost of insurance is crazy for that. So you can insure for that separately. It depends what you want to do with the policy, right? So if you want, for example, another strategy that I would also share is when you have, let's just say you have a certain potential earnings in your life. And this will tie into what you're asking right now. So let's just say you're 30, the person is 30 years old, there's a spouse, there's two young kids that make $100,000 per year. Well, the insurance company or carrier is going to look at that specific person and say, there's about 30 to 35 years, let's say to age 65, of potential earnings that can be insured, right? So they would say that there's about a 3.5 million, maybe even 4, if it were to 70, of income to protect for that family and for the children, because the children has to go to school. I mean, that would be the loss, the financial loss for that family at that snapshot and point in time would be, let's just say 4 million for our numbers. Now, the way that we structure the policy, we always make sure that people understand that you're not fully insured from a life insurance standpoint necessarily. at that point in time, because this is structured for max cash. So let's just say from a maximum cash value policy, overfunded whole life, like such as this, the death benefit is now $1 million, but there's still a gap of 3. So you would get a convertible term to make up the gap that can be converted on later to more whole life policies. That's one way of doing it. And the reason you would get the convertible term is you could do that without medical underwriting. Now, the reason why I'm sharing this is you have to think of what's my goal with this policy. So if it's a place to warehouse the cash effectively and efficiently, right? And that's the goal with this, then is an exclusion a bad thing? Not necessarily, because maybe you get another policy, you get a convertible term or something where there's nothing is excluded. So you have a maximum efficient policy here that's structured. Maybe there's an exclusion on there if you're doing, bungee jumping in New Zealand or something, or with, jumping out of planes right there. But then there's another policy that's a little bit more pricey, obviously, because it does have that in. So that's the, I would say there's no clear-cut answer for everything, but have I personally seen that folks have passed away and stuff is not paid out because of certain behaviors? I have not personally seen that, but I would also just say that, you have to figure out what the goal is of a specific policy, how to set it up, and then figure out from an overall strategy, how do I make this work? Yes, I want my money in there for this reason. I want to structure my own bank. But yes, I also want to do this. So maybe I pay a little bit more in insurance there and then less here and have the exclusion there. So anyway, this is something we could talk about too.
And can you unmute Bobby Rodriguez? He has a question for you.
Yes. So let me just see here. How do I, participants. Okay, here we go. So let's say, Bobby, there we go. Unmute.
Wrong one. It's Bobby, not Bob.
Okay. Okay, hang on. So let's see. Okay. Okay, this one and then this one. If I can get the button correctly. Did I get it right? Did I unmute you? Doesn't sound like it. Hang on one second. How about now? Hello? There's a Bobby and there's a Bob.
Unmuted. Bob, can you hear us? Bobby? Well, I'll recap the question the best I can. What he was asking is there a living death benefit? I guess is what it's called. So saying like if you get cancer and find out you're going to die in 4 months, is there any, I guess maybe he means early access to some of that?
Yeah, chronic illness rider. There's a rider on there that's called the chronic illness rider. So yes, it is. There is certain things on the contract. These are all great questions, by the way. This has been great. I'm trying to see. Okay. Yeah, and I'm trying to think of other frequently asked questions, but I think we covered quite a bit. Yeah, and if there's any specific, and again, I'd be happy to discuss with anyone specific situations. Oh, here's another frequently asked question that just came up to mind. I'm uninsurable. Something happened, an event, whether it's a cancer scare or a health issue, I'm uninsurable. What are my options? How does it work? So this happens more than I think a lot of people would think, but it's in a situation where, let's just say there's some family planning involved, and then the one spouse is insurable and the other one's not. So what you can do is actually still build a family bank with the spouse that is insurable being the insured on the policy. And then both of them being the owners of the policy. So let me just restate that. So the one person would be insured, but both people, including the one that is not insurable, would be owners of the policy. And they both have access to the quote unquote family bank. So that's one way of doing it. And for that, just staying with that kind of that theme, is parents can be the owners and the payors of the life insurance policies on children, children being the insured. So the parent has control over the policy and the money of the policy, but the child is still the insured. Now, obviously, you're setting this up for the child because it's a savings vehicle, right? Very, very powerful stuff if you compare it what else is out there. So you can set it up in a way that there's money for the child to go, to pay for private school or pay for schools, to help them buy an automobile or a vehicle when they turn 16. Obviously, teach them the banking principles and how they are paying back their own bank. Then to go to college. Maybe if college is not a thing anymore, my kids are young. Maybe in 20 years, hey, college is not a thing anymore. So what then? Well, there's money to start a business. There's money to invest in real estate. There, for the journey of the child, there will be capital available in these policies, but the parents have control over the money and they have control over paying it through until they decide that they're ready, basically, to either sign the policies over or it's just kept in a family trust, depending on the level of estate planning. So, obviously the parents want to maintain control of that until they feel that the child is suited. I know my parents signing off a policy to me when I was younger would probably not have been a good idea. So there's a lot of different ways that you can do with that. But that's a frequently asked question too. What happens if I'm uninsurable or I've had a certain health issue? I guess what I'm trying to share is, yes, there's options and there's things that you can do. There's a lot of people that own insurance policies on each other when there's an insurable interest. So, for example, COLI, corporate-owned life insurance, where the corporation owns life insurance on policies on the employees. BOLI, bank-owned life insurance, is kind of the same thing. So, that's kind of how they do that.
Well, I don't see any more questions, but you might get some because this will go out. We'll send the recording to everybody in the office, and I'll figure out what a watch party is, and I'll try to start that on Facebook so everyone can rewatch it who didn't see it.
Awesome.
And then, I think it's good stuff. We appreciate your time, and I think you'll probably get a lot of calls because a lot of people stayed on for this entire thing. So
awesome. Well, I really appreciate the opportunity, Joe. This has been great, and you guys have been great. If anybody wants to reach out and have a chat, be more than happy to chat with anyone and answer any more questions. And I appreciate all of you. I hope you all stay healthy and safe and enjoy the time with your family. And what a great time to build your business too, right? So appreciate you all.
Thanks, MC. I'll see you.
All right, bye-bye.